Okay, so in our last videos that we had, we were looking at the components for a budgeted income statement. And so we started off looking at a sales budget, and then we followed that up with a cost of goods sold budget. Both of those, though one is a revenue and one is an expense item, both dealt directly with product costs. However, we also have to go ahead and consider the selling and administrative expenses budget because these expenses certainly do impact budgeted net income for the period. So here we have a selling and administrative expenses budget for the period, and as you will notice, we don't see, we don't have revenue up here, we don't have anything about cost of goods, but what we do have is we have some ordinary and necessary business expenses, and we've broken those down into selling expenses and administrative. So we've got some rent, salaries, all the typical things that you are likely to find on an income statement for any number of companies. Okay, so even though these are not, these represent what are called period costs rather than product costs, we still have to account for these items. And so if we think about the budgeted income statement, we've already discussed the sales budget and the cost of goods sold budget. So this selling and administrative budget is that we just discussed is the final component. After we have all three of these budgets completed, estimates have been made, we can go ahead and we can come up with our income statement, our budgeted income statement. And so here we have one. If we go back and look at some of our other slides, we'll see that we were able to budget revenue at 13.336 million, cost of goods sold a little over 9 million, and we were able to come up with budgeted gross profit from there. Then our selling and administrative expenses, we broke those down into selling expenses and administrative expenses. That's on the previous slide. We've got those here. And then finally, we're going to come up with income up from operations. That's our 4.28 or 4.29 million gross profit minus our total selling and administrative expenses gives us income from operations of 2.4 million. Probably should point out, and it was on one of the slides, a couple of slides back, on this budgeted income statement, we do have all of our non-operating type items on here as well, such as interest revenue, if we have interest revenue, interest expense, and then we'll also have items such as our income tax, our budgeted income tax expense for the year, to arrive finally down here at our budgeted net income. Okay, so that's it for the budgeted income statement. It's those three components: the sales budget, cost of goods sold budget, and the selling and administrative expenses budget. However, we know that we can't make it on just the income statement alone. Our sales revenue is not always, it doesn't closely approximate cash collections, and it certainly doesn't account for cash inflows or expenditures not related in some way to normal sales revenue. Okay, so when we think about this, when we think about our cash budget, what we're trying to do is we're trying to determine, and we're going to kind of get to this in backwards, in kind of a backwards manner, but what we really are trying to do is we're trying to say, okay, we want to make sure that we have enough cash on hand at any point in time. And so what we do is we determine how much cash we want to have, and then we try to estimate inflows and outflows of cash. So let's say that we want to have $300,000 on hand. We're going to go ahead and we're going to budget for things like cash receipts, cash outflows, or cash expense items. We're going to have to make some adjustments for depreciation, because depreciation is an operating expense, but it is a non-cash expense. And then when we do all of these things, we're going to have to say, okay, how close are we to, at the end of the day, being able to maintain that target cash balance on the income state on a day-to-day basis. Okay, so it says here on our slide, if we think about the information on this slide, I want you to kind of, in your mind, go back to what you know about the statement of cash flows. Hopefully you remember something about it. But it says here the primary source of estimated cash receipts are from our cash sales, and then whenever we convert accounts receivables into cash. That's what they're talking about here. But we also might sell stock in the company, or we might issue bonds, such as debt financing. Another type of debt financing would just simply be if we go to the bank and borrow money. So when we think about all of these things combined, it might help us if we come up with some type of a schedule of collections, regardless of whether these collections are from ordinary business transactions or if they're from the issuing of stock or the issuing of debt. So here we have some cash receipts, or an estimated cash receipts. Now we've made this, it may not look simple, but what we've done here is we're only focusing on operating type cash. We don't have anything here related to funds that we have received for the issuance of stock or the issuance of any type of debt. Everything is based upon sales and the collection of cash from those sales here. So we've got 3 months, the first quarter of the year, January, February, March, and then we have budgeted sales for each of these months, okay? We're also going to come in here and we're going to say, okay, as of the end of the prior year, we had $480,000 in our accounts receivable for the company. And we also have kind of a formula, a budgeted formula that we've come up with that basically says whatever our sales are for the current month, we're going to collect 60% of that in that month. And we're going to make sure, we're going to make it kind of easy, and we're going to say that we're going to collect all 40% of the prior month's sales. So when we look at this accounts receivable here for January 1 of $480,000, we could actually take $480,000 and divide it by 0.4, and we could arrive at what our sales were for December. Just doing that in my head, I believe it would be 1.2 million. Okay, so let's see what we have here. Let's see here. We have this company, Elite Accessories. Did they name it back here? They did. Okay, Elite Accessories, and looks like we're trying to determine the amount of cash receipts from operations for the month of February. And so if we go with the same formula that we had before, if we're talking about February, then we're hoping to collect 40% of our sales from January, which was $1,080,000. And then we're also going to collect 60% of our sales from February, which is 1.24 million. So if we look at this, we take our budgeted sales for January, which was $1,080,000, and we're going to collect 40% of that in the next month, or February, And if we perform this calculation, we come up with 432,000. For the current month, our budgeted sales are 1.24 million. If we multiply that by 60%, we come up with 744,000. We add these two figures together, and we have budgeted cash receipts for February of $1,176,000. So this did not turn out. I have a little cheat sheet over here. You can if you can see this, that's great. I don't believe that your PowerPoint, your static PowerPoint presentation has this over here. This is from 2 slides back. I just put that in there so I wouldn't have to jump back and forth. So that's mostly to help me as I do this presentation. But we have a schedule of collections or cash receipts for the first quarter of the year, and we've already calculated February, but we also have here both January and March. And so we said that $480,000 represents 40% of the December sales transactions, or 40% of the December sales made on account in December. And so for January, we're going to make the assumption that we're collecting that 480,000. The other part of the January cash collections, 648,000, comes right here. If we recall, and I actually am going to go back to right there, we said that January was $1,080,000. And if we take that let's see where we at, $1,080,000, and we multiply it by 60%, because we said that for any given month, we're going to collect 60% of the accounts receivables in that month. That comes out to 648. We plot that here, add the two numbers, and we say, okay, we're going to, in January, we're going to get 1,128,000. And I'm not going to go through March in the interest of time, but we do have the calculations here. And we will have to, you'd have to go back a couple of slides, but we have the March budgeted sales there, 970,000. And so you can do the same thing using these figures here for the month of March. All right, so that's a look at budgeted cash receipts, or estimated cash receipts. I think I'm going to go ahead and stop this video, and then we're going to look at estimated cash payments in the next video.